there was a shift that was happening, and this has been happening for probably the last 10 years or so, where folks were starting to move from more public portfolios, the general 60/40, into increasing their overall slice of alternatives. And what are our alternatives?
Welcome to Self Made. We're here with Ben Schuster today. How you doing, Ben?
Doing well. How you guys doing?
Great, thank you. Thanks for coming on. It's been we've been trying to get this one on the cards for a little while, so I'm glad we all found the time to do it.
Yeah, I'm looking forward to it.
Yeah, come on. Well, why don't you jump us off with a bit of an introduction, kind of share who you are and kind of the exciting things you've done up to now, and yeah, give us a quick summary of the past.
Yeah, absolutely. So I spend most of my time in private equity real estate. I started my career at BlackRock and I spent about 7 years there in total, doing a couple of different roles. I started out on the capital markets desk, did that for a couple of years, and I always wanted to pivot and get onto the real estate operations side or the investment side, the principal side of things. And so while I was at BlackRock and on my first entry level role, uh, I was thinking about leaving BlackRock and going and getting my MBA and repositioning myself to hopefully get a role on an investment private equity real estate team. And I was speaking with a mentor at the time, and she mentioned not to do the MBA route and instead take an internal role at BlackRock where I was going to be in charge of the capital formation side of things. So, raising institutional capital for the real assets platform, which is the private equity, real estate, and infrastructure investment group across both equity and debt, as well as listed securities. So, I took her up on that advice. I successfully took on that role. And for about 3 years, I was on a team called BlackRock Alternative Specialist Groups, which is just a fancy way of just saying that I was engaging institutional clients and raising capital for BlackRock's private equity real estate funds. Did that for a handful of years, really enjoyed it. Got to meet and sit in conference and boardrooms with institutional clients, really understand how they think about investing, as well as interacting directly with the senior leaders on the investment team. I then took that position and leapfrogged actually to getting onto the real estate investment team. And I did that for a little shy of 2 years. During that time, this is COVID. My wife and I, we really relocated down to San Diego. We bought a home that we thought was just going to be a rental. We ended up living in that house and commuting to Newport Beach, or at least I was commuting to Newport Beach because I did an internal transfer to our Newport Beach office. And during that time, we were sitting at a Starbucks one Saturday morning, and I overheard this gentleman that walked into the Starbucks talk about mobile home park investing. At the time, I've never met anyone that's done manufactured housing or mobile home parks or trailer park investing. It was an asset class I was familiar with, but never met anyone that actually did it or did it well. And so on his way out, I stopped him and asked him, hey, I overheard what you do. That's really interesting. I'd love to buy you a coffee sometime and pick your brain. He said, sure, what do you do? And I told him that I was at BlackRock on the investment team, and he was really interested in what I was doing. And so we just became buddies for about 1 to 2 years, just catching up casually, talking about deals. And then he and I kind of came to, a realization that it's probably time for me to leave BlackRock and come and join him as they were looking to shift some things around internally with the business and bring on someone onto the team that was going to be purely dedicated to investors, growing the investors, and putting an institutional, I would say, layer over the capital raising business. So just elevating that brand and that process of raising capital. And so last May, so May of 2023, I left BlackRock, came over as a partner for the firm I'm at now, which is Comfort Capital. And that's where I'm at today. I'm happy to chat more, but I'll pause there.
Very cool. I mean, I'd love to dive a little bit more into BlackRock before we move forward. I mean, that's obviously one of the bigger names, if not the biggest in the PE world. We've kind of, had a few people we've spoken to in the family office space and the PE space, but I'd love to kind of get a little more of a deep dive on your perspective of that. Like, firstly, how you really got into that, and then your experience of being there, kind of what you learned and what you observed from your time there.
Yeah. So how I got there, I took a very unconventional way of getting there. I went to a small state school and really just, I consider myself a bit of a hustler. I got a little bit of grit and not afraid to roll up my sleeves and do what needs to be done in order to get a spot on the team. And so that's kind of how I initially got into BlackRock. I really, hustled and networked my way into actually getting an interview. And then once you got an interview, it's all cards are on the table, and that's up to you to, in order to secure that position. But it's just so hard just to get your foot in the door and just to even get an interview. And I'll just give you an example. When I initially applied for BlackRock undergrad, I didn't even get a call back. And when I was on the other side and I saw how many resumes we would get, I totally understand why now I never got a call back. And the way that I ended up getting that job is because I had a couple of friends that I knew during college that I networked with that went to that same undergrad that were now working at BlackRock. And I got a call in February, and one of my buddies is like, "Hey," he was working at BlackRock. "Hey, we just had some unexpected layoffs. We're going to be rehiring some junior folks. Send over your resume, and I'll print it out and put it on the hiring manager's desk." And so that's how that happened. So hopefully, listeners that are looking to maybe get into that broader, larger private equity, marquee investment firm, if you just submit the resume and think you're going to get a call, the probability is pretty low. You need to be reaching out to folks directly on LinkedIn or however you can, um, make a connection and start that way. It goes a long ways. And then just to answer your question more directly, what is it like? I guess from my space, when I was raising institutional capital and I would go speak with institutional clients, there was a shift that was happening, and this has been happening for probably the last 10 years or so, where folks were um, starting to move from more public portfolios, the general 60/40, into increasing their overall slice of alternatives. And what are our alternatives? So alternatives could be hedge funds, it could be private equity, real estate, private equity, infrastructure, it could be private credit, traditional private equity, right? So this is, and this is your folks buying and acquiring not private companies and then looking to increase their, EBITDA and then hopefully exit at a higher multiple and generate a return. So these uncorrelated, alternative asset classes really started to gain a lot of steam, and BlackRock invested in a heavy way to expand their offerings. And you're seeing, if you talk to family offices, which I know you guys do, or anyone else, family offices have been doing this for a long time, but now they're just more broader adoption across all institutional as well as like high net worth or individual investors to have a larger slice of their portfolio in alternative investments to reduce volatility and essentially get alpha.
So they're looking for higher returns and uncorrelation, basically, is what you're saying?
Yeah, that's exactly correct. And there's a term called an illiquidity premium, meaning that there is a premium to returns for not having them be as liquid. So like a good example is if you look at like a REIT, like a traditional public REIT that trades on the stock exchange, it has liquidity, but then it has a lot of volatility on the prices. And, some could argue it has price discovery where like actual real estate, the underlying real estate is trading at. But if you hold a privately held, real estate asset, let's just say like a class A apartment, you're not mark to marking that asset and you don't really care to mark to market that asset because you know that you're collecting X amount in rent every year. And then if when you do go to sell it, because you've driven rents or increased the value of that property over time, you're going to sell it at a profit, right? So that's kind of what people talk about with that illiquidity premium.
Do you think there's a premium because of the illiquidity that people can't sell at a moment's notice, and it forces them to kind of stick it out and see it through for what's needed.
Yeah, that's a great point. I would definitely say that there's a component of that because if you're not a forced seller, right? Like even if you just look at like what happened with First Republic Bank, if they were a private bank, they probably would have done just fine and not had to close operation and get absorbed by JP Morgan. But because it was listed, it was a publicly traded stock, people knew that they owned way too like long duration bonds that had gone down in value because of what happened with interest rates. They essentially are looking at the book value and then they're trading and they're shorting that stock, which puts a lot of pressure on the company to be able to raise liquidity and be able to sustain and essentially shut their doors. So yeah, there I think
Well,
that
that was part of the same issue, right? Is that the bonds weren't marked to market. So almost kind of the opposite, right? They're not marking down the bonds, so they're actually not as liquid as they're claiming to be.
exactly, but I think the stock uh, I'm talking from on the stock side, they're taking a look at that and then they're shorting those positions knowing
Right.
that yeah,
Hmm.
from a mark to market point of view because you have transparency, right? They know exactly the entire there's public reports. They can look through these and then understand, oh wow, this company it doesn't have the liquidity. If you look at from its liabilities to its liabilities are much greater than its assets because the assets were not getting mark to market for
Yeah.
those long duration bonds that they had to hold.
And a
Um,
lot of that was because they didn't have to, right? Wasn't there legislation that said, hey, you don't have to? They let them get away with that for longer?
Yes, I believe so. I'm not a banking expert. There's a lot of stuff that's
Hmm.
happened with Dodd-Frank and other legislation that has required banks to, have X amount of assets and what it is it, what's the duration of those. So
Hmm. Yeah. From
my
my
for,
understanding, it was a COVID relief thing that said, hey, you don't have to mark it up as quickly. Like, you don't have to mark these to market. We're going to give you a break so you can just hold on to these.
yeah, and it's unfortunate that, that bank now has since it's non-existent. Um, but it kind of ties into the point of private first public.
Hmm.
If that was a private entity, it had a lot more flexibility to be able to maybe slowly sell off those assets, buy into new bonds or shorter term debt. But because, they came into a liquidity crunch, people are shorting that stock, you're kind of put between a rock and a hard place. And so
Hmm.
that illiquidity premium can work both ways. And you're starting to see a lot of companies not choose to go to market or like go public and stay private
Hmm.
for longer.
Or
And so
leave.
exactly. And that has a big impact on the investment banking industry that makes tons and tons of fees from, M&A and bringing bringing companies to market. And you're seeing folks just wanting to stay private for longer. And there's a lot of liquidity, meaning private equity, that's stepping into that gap to provide them with that capital. Because the reason why, generally speaking, people like to go public is because you're going to access capital, right? At effectively, um, a cheaper rate or a cheaper cost of capital
Hmm.
because you have public individuals that could effectively buy your stock and you can raise capital through that way and you could sell shares and issue out new shares or buy back shares. So there's a lot of flexibility with that. And the same thing that's happening on the equity side, that's playing out in the private credit side. So that's why private credit today is so attractive. One, it's not because of just the yield you can get, 10+% in my case on the real estate side, but it's also because of the quality of the underlying collateral. Because more of these, banks as they pull back, these other players are stepping up in a big way, and that's all alternatives. That's all private, on the private credit side. So I think just the adoption around this, the access, you know, the uh, democratization, I guess, if you will, of alternatives has grown, and more people are able to access these types of deals.
And now, is that kind of so? What you're doing today is the private credit side of things.
So I I focus 100% of my time on the private equity real estate side. We buy manufactured housing communities. So
Mm.
you could think mobile home parks. These are land lease communities. The tenants own the homes. We own the land. There's shared amenities, clubhouses, roads, infrastructure, those types of things that we are required, and we make sure that we elevate that. We are a manufactured home dealer, so if we buy a community and there's vacant space, or there's an opportunity to expand the park, add in more homes. We're actually a dealer, so we'll run our dealership on the actual physical property, meaning we'll finance these homes, put them on the actual property, and then sell them directly on site. And then we have a vertically integrated with our property management team, Comfort Communities, and then the private equity arm is Comfort Capital. But we focus on raising capital for the equity sleeve. We generally, on the debt side, we're getting agency financing. So you could think Freddie, Fannie, uh, loan to values around 50%. And then we are cash flow investors. So the tenants, they pay monthly rent. We turn around and pay that income back to our investors in the form of a monthly distribution. We drive occupancy, increase the overall quality of the parks, drive rents, and then call it 7 to 8 years, we'll then sell that, and sell that entire property. Um, Historically speaking, at a good return, and then we'll 1031 exchange that gain, that realized profit, into the up leg of a new deal, compounding cash on cash returns and deferring all capital gains and taxes. So it's a fantastic way for private investors to defer taxes, realize a after tax higher cash on cash return, and then grow their principal balance to exceed inflation. And as well as when you look, when you compare it to when you compare it to credit, that all-in return is much higher than that of credit, because you're not just getting the yield, you're also getting the appreciation. Because you know real estate equities are a quasi bond plus equity. The
Mm.
bond meaning it's a cash flowing producing asset class. But the equity, you have that appreciation that occurs through increasing your revenue or your NOI, and then dividing that by a cap rate, which I believe you guys are private equity folks. So cap rate is just an inverse price to earnings ratio, and that's where that value gets derived from on the equity side.
Mm. Question: When you're doing the sale and the roll into 1031 exchange, is that doing a new vintage, or is that within the same fund? Or you just everybody, hey, we're rolling over to the next one? What does that look like for that exchange?
Yeah, no, it's a great question. So we're not a fund. So just
Okay.
taking a step back, just so it's clear, we do deal by deal syndications. So they're
Mm.
separate LLCs. So it's not a blind pool fund, meaning that when we raise capital once we have a deal identified and we have control over that deal, and then we generally have about a 60 to a 90 day window to then raise that capital, raise that equity, and then close on that deal. So it's a very
Okay.
fast paced process, but for investors, it's a huge benefit because it's not a blind pool fund,
Mm.
meaning you know exactly what you're putting your dollars towards. You can see the property, you see the financials, you can go visit the property, versus us saying, this is what we're targeting. We're going to look for 100 to 200 site mobile home parks and in the top 10 MSAs in the United States that have city services and utilities, and we want to target a 12 to a 15% return. That's great, but the way that we do it is that, hey, here's the deal, it's located in this submarket, here's the address, here are the photos, here's the business plan, and here's the 10-year pro forma or the 7-year pro forma that we're projecting.
So how does that differ then for like a fund structure? I guess it's not an LP and GP,
No,
or like
yeah,
it still is.
it still is. Yeah, it
Okay.
still is. It's just with a fund, generally speaking, and I could talk about the fund structures that I would see at BlackRock, but generally on a fund, you're not going to have the ability to 1031 exchange after the fact, because a fund model is generally set up where we're going to raise a certain pool of capital and we want to buy, and then here's our target exposure. Maybe I have one deal tied up, but then you're going to commit, let's just say you're going to commit $1 million to me for us. And it's a $10 million fund that we're raising. We're going to go buy $20 million of real estate because we're going to add in debt, and I'll start to draw your capital as deals come into play. We'll sign the docs and the contracts, but I won't draw your capital until I have a place to place your capital. So if I have one deal tied up and it's a $20 million overall fund, inclusive of the equity and debt, and it's a $10 million deal, I would probably pull $500,000 of your equity that you committed, and you would have the other $500,000 sitting in your bank account or in a CD or something liquid in order, because I'm going to probably call
Get
on
a
it in
call.
another 6 months, right? But the
Right.
reason why that is because I'll give you a preferred return or preferred equity, and I
Okay.
don't I don't want the entire $1 million to start accruing the pref. I'll just have $500,000 accruing the pref,
Right.
and then because I'm going to give you a pref, I know that I'm going to try to target a specific IRR. So then once we do sell it in year 5, hopefully it's an 8% pref, and then everything after 8% goes 80/20 or 70/30 or
Sure.
60/40. But I want to try to maximize that IRR. One, so it looks really good for my track record. But two, once I get further in the waterfall, usually the more of the proceeds go to the GP or the
Right.
operator.
Hmm.
So in our model, because we're cash flow investors, we're not really monetizing to a specific IRR because an IRR is a time weighted calculation.
Hmm.
You could have a really sexy IRR, but you could have a pretty crappy equity multiple. And so what we really focus on is the equity multiple and the average annual return versus the IRR, because we're not forced sellers. We're not
You're not
really
on the
trying.
clock. Yeah.
Exactly. And these assets are really hard to acquire. So once you have a really strong property that's giving you really good cash flow, you don't want to sell that asset, be in a 1031 exchange, and then buy a crappy deal, right?
Yeah.
Because we roll all of our capitals in our deals as well. So we're allocating based on what's best for us and the investors collectively, because we're not pulling money out of the deals.
I see. So it's a lot more of a buy and hold kind of strategy, and it's the same people, not necessarily people coming in and out
That's
when you
correct.
return capital.
And when we do sell a deal, you could always redeem at that point once your position has been like crystallized, right? Well, like
Hmm.
that return. But I would say like 95% of our investors invest with us because they like the fact that we continue to compound and roll their gains. And then generally speaking, we're buying a larger deal
Yeah.
after we sell. So then we raise new capital alongside of those new on the uplink of the new deal.
Yeah. That's cool. I like that it's like a longer term relationship then with your investors. It's not just like in and out in like a 5 year stint. It's, 20 years maybe with the same people.
Yeah, we've been operating for 15 years, and many of our investors have been with us for 10 plus.
Love it. I vouch for Comfort Capital. um, Ben, there's a couple of things I'd like to dive into. Similar, but kind of perspective or mindset when you're working in a place like BlackRock, firstly, and then on the flip side of that, say a company that's trying to sell to private equity, what they would want to be mindful of or have when you're bringing something like that to a private equity firm to be mindful of. So like kind of the being inside of it and then what they're looking for, but also like as a seller bring something to a private equity, what they need to be mindful of as well. Now knowing the inside scoop, having worked there.
I guess there's a lot to unpack there. I think just like I'll just more broadly, like I think going to an institutional client or to a private equity firm with a deal, keeping in mind that track record is going to be really important to them. So they're going to want to look back over 5 to 10 years and have something they can underwrite or some proof of concept. So that's going to be first. That's going to be the first thing that they'll look at. The second thing is just like conservative or realistic numbers. So understanding that, and I'll just speak to real estate because that's just that's what I know best. Like today, the market has shifted. Like the 10 years at 4.5%, right? The Fed funds rate is at 5.25 to 5.5. So if I brought a deal, or if I was trying to sell a deal, I was trying to raise money from an institutional client, and I said, "Oh yeah, we're going to buy this deal at a 3.5 cap or a 4 cap, but it's irreplaceable. It's an awesome deal, right? We're gonna buy it at a 4 cap. Like they're gonna look to me and say, like, that doesn't really make sense today because even if it's such a great piece of property, it's gonna depreciate, things are gonna go wrong, you have expenses. And I could just go put my money in a risk-free asset like treasury and clip 5%. So why would I take all the added risk and buy something that has a yield or a cap rate of 4%? And then you kind of talk, oh no, we're going to do all this stuff with the value add and increase the rents and all of that. So I think just like having a really realistic sense of like the the opportunity cost of other investments or other alternatives. I'm not saying alternatives from like, the investment, like
Just different options.
different options, right? It's like people, I think you need to one understand that that all investments carry a sort of risk, and then institutional investors, private equity investors, because of their size and their sophistication, they can allocate across what's the best type of opportunity. So, you know, I think that like that's really important. So, like when you go in and you're presenting something, like it does the return compensate you for the risk you're taking, understanding what those risks are, and then understanding what the alternative would be if they invest in a less risky asset. Is that premium or is that spread, that delta? Does it compensate them for that additional risk? Like another example, like institutional private equity investors, for the most part, a lot of them are just US focused, but a lot of them as well look at these types of investments more holistically across the globe. And so understanding what's happening in Europe or Asia, or if you're like presenting a deal that's say in Asia, I mean, right now in Asia, like that deal needs to scream and have such a higher premium to something in the US just because of all the risks that are going on. And
Mhm.
those are the types of things that institutional investors are going to look at. They're not going to look at your deal. They'll one look at it as standalone, but then they're going to zoom out and understand, okay, if we allocate our risk budget or a specific amount of our dollars into this deal, what are we giving up outside of that for a different opportunity? So
Mhm.
hopefully that's
So
helpful. It's kind of
I say it sounds like always put it into the frame of the risk adjusted return. Like know what else is out there, and it all comes back to risk adjusted return.
yes, and understanding the market is really important. Folks like analysts or folks at private equity, you got to remember a lot of these folks are just salaried employees, and so they're
Mhm.
paid to underwrite and understand and really dig deep into your deal or into the deals. So if you are looked at as an expert and you can educate them and make them better at their jobs so they can look smart in front of their bosses when they go up for promotion or when they get their bonus, like that's another, you want to like create those win-win opportunities. So if you just kind of go in and just think about what is it for me and you're presenting the deal and you think it's a great deal, but you're not looking at how can I not only sell the person that's sitting across the table for me, but how can I make them an advocate and make them think how I think and look really smart in front of their bosses once they do this deal and they can articulate that way they can advance their career or their own, you know, selfish obligations in life, right? So just other things that are just kind of coming top of mind as I'm thinking through this question.
That's an interesting perspective on that because I know, like, if you're vouching for a deal that goes south, that can risk their career. So it's kind of a two-edged sword, right there, isn't it? So
Yeah, and I and
interesting
I think
perspective on that.
And I think people don't understand that as well or think through that when they're, who's sitting across the table for them. A lot of the times when they're allocators, whether they're institutional clients or private equity folks, generally speaking, they're not they could be a decision maker whether or not to invest in your deal, but they're not the owners of the company. And so the way that they get compensated is generally on how well their investments do. And
Mhm.
so, and
It's
or
more of
how
a don't screw it up kind of thinking rather than can we make it big? How do we not screw up?
Yeah, and that's why a lot of folks, private equity shops that have been around and continue to grow that, maybe their returns aren't amazing, but they haven't screwed over their clients, the safe bet is like, oh, let's just go with Blackstone. Let's just go with
Yeah.
Carlisle or Apollo or whoever it is, right? They haven't screwed us up
Hmm.
before, and it's the safe bet. But if I take a risk and go on this new operator, then I'm really gonna, they're kind of putting their neck out,
Yeah.
and they can look like a rock star, right? But they need to really understand your deal, the market, and so that's where you, as the operator on this side of the table, you need to be in charge of like educating them and not assuming. Like you just don't go into into a conference room, do your pitch, leave, and then follow up. Hey, what do you think? Like you need to be continue to drip on them. Like here's a great article about our industry. Maybe it's the HVAC. I believe you guys do a lot of like roll up strategies, right? So like here's
Hmm.
talking about the growth and the adoption of the HVAC, plumbing, electrical industry roll up strategy where high net worth family offices are starting to dive in. Here's a recent article from Forbes that talks about this. Understanding if they're analytical. I just want to send you some of our initial underwriting, and we did some stress testing on the portfolios as well. And here that way you could start to educate them. And a lot of times you will get follow up emails, but if you're sending them things that they're interested in, they'll read them. And then, one day maybe it just clicks for them and they're ready and they have a mandate where they're going to target this market. And then that's your time to shine. But, always be selling, meaning don't always be selling or building a relationship when you have a deal, but be doing it with folks that you believe could be good partners at all times, because it might not, you want to make sure that you have a really good relationship and the person across the table from you knows you, trusts you, likes you, most importantly, when there is something live. That way they're not necessarily underwriting you as a person. You guys are just speaking through the details of the deal.
Yeah, very interesting. Always be selling. Was your experience in the PE? Was it kind of like Boiler Room meets Wall Street, somewhere like that? Coffees for closers.
No, it's a lot of, yeah, it's hard to raise capital.
Hmm.
It's hard to find deals and it's hard to raise capital. I always joke and tell folks that raising cap, the person that raises the capital and the person that's finding the deals are the two most valuable jobs in any investment, private equity, uh, you know, in the industry. In my opinion, the two most scarce things. Everything else can kind of be a W two, or it can be a role that you could hire for, where there's a surplus of labor for the most part. But it wasn't necessarily boiler room. It's a lot of emails, outreach, road shows. So you got a new fund that's coming to market or a new deal. You're putting
Steak
together
dinners.
Yes, you're putting together the pitch deck. You're trying to get out on the road. You're trying to say if you're going to Texas, you want to meet with all the big Texas institutional clients. You're sitting in the boardrooms. You're bringing with you the head portfolio manager, the head kind of investment person, and you're just getting to know people. And it's a lot of follow up emails. It's a lot of sharing content and articles and research and just staying top of mind. And yeah, it's a grind, but it can be really fun. I enjoyed that I did that institutional capital raising, but I like my current role and my investors, like the fast pace of it, so much more now, just because on the institutional side, the sales cycle is so slow because there's so many different decision
Yeah.
makers. The market can shift in a second and you can lose your mandate. So I just really like the ability to raise capital from family offices, high net worth, and accredited investors versus trying to, hunt the whales. And I'd rather just, go get on a small fishing boat and just tunas and catch tunas all day long than try to like be out on a ship trying to take down a whale. It's just I like the fast pace of it. I enjoy interacting with a far larger group of individuals, and it feels a lot more entrepreneurial. At BlackRock, at my time there, uh, you know, it just things move slower. It can feel a little bit corporate, and you could feel as if you should not or cannot make a huge impact without like being a managing director or heading up a team because of that insecurity of that, am I going to say the wrong thing in the meeting? Is it going to risk, it's those types of, maybe that was just me, but now it's just me speaking directly with the investors, the clients, all the content that comes out. I wrote it all. I reviewed it. Maybe I sent over to a couple of other people, but I like I like betting on myself, and two, most importantly, also having a say on what the deals we're buying. So I will never raise a nickel for a deal that I don't believe in, that I wouldn't put my own mother in. So I really like the fact that I'm controlling both sides of the coin, if that makes sense. Because at BlackRock, you had no control what deals they're buying.
Yeah, and
Whatever
you're
the
not
deal,
investing in it personally.
correct, exactly. And so yeah, I prefer, even though it's smaller, and it's maybe doesn't have the brand recognition of saying you work on $1 billion deal for BlackRock. To me, it's far more exciting and a lot more fun.
Probably better taste of the upside too. I'm sure, because it's
Yeah,
just you. You don't have to give any to the house.
yeah, that's exactly correct. That's also an added bonus.
Yeah, no, very good. Where do you see yourself, say, in the next 5 to 10 years? I mean, you're in a pretty good spot now. Do you see yourself continuing kind of on the current path or kind of evolving from there in the future?
I I personally, I always tell everyone I'm an investor first and I raise capital second, but I love raising capital for deals. I love storytelling. I'm a deal junkie, so I think, as I see myself in the next 5 to 10 years, whatever I'm going to be doing, I can tell you it will be in real estate, and I will most likely be raising capital. Um, so this is something that I've worked, my entire career over the last 10 years to try to get to. And now that I'm here, I have no plans on like pivoting and doing something different. But I love real estate. It's really, I don't think I'm the sharpest knife in the drawer, the brightest bulb on the tree. And real estate just makes, it's so intuitive. It's a discounted cash flow. It's a net present value. It's really easy to understand, and I like getting out and driving markets and understanding population growth or job growth, and understanding that if you have those two things and you have a shortage of homes, which you do in the US, it's probably going to drive rent growth, right? So it's like really like intuitive, simple ideas that I can understand and grasp and explain to other people and put my capital in, as well as tell them that they should put theirs in as well. So I don't know exactly what I'm going to be doing in the next 5 to 10 years, but I'll definitely be raising money for deals and continue to, uh, invest in real estate, and we'll see what happens.
Do you see a long future ahead for the manufactured home space?
I do. Yeah, I do. I think it's going to be the affordable. I think manufactured homes is the most realistic solution to the affordability crisis. The fact that you can build a house in a factory, and it's hard to tell. Besides, it sits up on a chassis, and it has a skirting around it that it's different from a site build home or a stick build
Hmm.
home. And you can get a single wide brand new for $50 a square foot. So to me, that's where I could see the U.S. going more and doing more manufactured homes. In terms of our space on the park side, there is only about 40 to 50,000 mobile home parks in the entire United States, and that supply every year is coming down due to these parks getting redeveloped or repurposed. So it is a smaller, I'd say, opportunity, right? It's not as, you don't have that continued supply growth that you see in apartments per
Why do you think
se.
that
But
is? Is it just hard to zone for them?
yeah, zoning, NIMBYism, right now in my backyard. Generally speaking, municipalities don't love adding a mobile home park to their town or their city. They weigh on the tax revenue. So because they're not subdivided and it's a large parcel of land and it's a lot of families that live there, that the amount of tax revenue doesn't generally cover things like schools or, so it's a net loss.
Hmm.
And generally speaking, residents don't love to have mobile home park next to their home or
Yeah.
anything. So that's a big reason why, which is really unfortunate because manufactured housing communities are the most affordable non-subsidized housing in the entire United States, and there's not really a close second. And it is a quasi between that build for rent product and a build for sell product where the tenants actually own their home. They have a garden, they have a driveway, they have space. They're not sharing four walls or an HVAC with, as in apartments with
Yeah.
their neighbor. So it's that sense of pride. And then because you're able to pool resources, meaning there's a park owner that has all the land, so you're not buying the land, you're just buying the home, which makes it affordable. And then, if it's a good park owner, which I think we are, you invest in the amenities, right? So the kids want to go to the clubhouse and they can do their homework, and the park is clean and safe because you have good rules and regulations that are in place. So people just can't have like old washers and dryers sitting in their, in their front lawn,
Mhm.
or an old car, things like that, like good security, good landscaping, good signage, good lighting. That way you can really bring that community feel, and people could have a sense of pride of ownership and a safe place to raise families um, without having to be pushed out further and further outside of the
Yeah.
MSA.
Interesting. Yeah, I know. I've heard that they're really good businesses, really great cash flow. But yeah, I guess I was just curious to see why the demand is shrinking. It sounds like. So, do they have to be zoned separately? Is it like a different type of zoning?
I would say I would just change what you said. The demand's not shrinking. The supply is. The demand
Hmm.
is, there's a lot of demand for these assets, and a lot of the large names that I just mentioned, whether it's Carlyle or Blackstone, a lot of the institutional players are in the way, are in our space in a big way because they love the diversification. They love that it's
Yeah.
a recession resilient asset class and all the things that you talked about. But it's the supply that is really that's shrinking. There's new supply that's coming on in places like Texas,
Mm.
but outside of that,
They don't have
it's
zoning.
it's like, like Houston has no zoning, so
Yeah,
you go into
literally
Houston,
no
it's
zoning.
yeah. I used to manage a couple of properties when I was at BlackRock in
Hmm.
Houston. It was pretty wild. Like one of them was an office building, and I was sitting at the top of on the 20th story, and I'm looking down into a $2 million home that's like right below it in like this
Yeah.
neighborhood next to this office district. It was just funky.
Yeah, they say, live and let live.
Awesome. Well,
Mm.
we're coming up to time here, Ben. If anyone wanted to reach out to you, what would be the best way? And if they wanted to kind of dive into a couple of deals or that side of things with you, what's the best way to contact you?
Yeah, absolutely. You can go to comfortcapital.com. There's a contact us link there that actually will go straight to my team. Or you could email me directly at ben@comfortcapital.com.
Love the name.
So the owners, just one last thing I'll say on that. The Comfort stands for Blake and Jen Comfort, who are the
Mhm.
co-founders of Comfort Capital and Comfort Communities. So yeah, it does have a nice ring to it, but it's actually their last name. So
Oh, that's cool.
Awesome. Well, thanks, Ben. It's been fun.
yeah, thanks, Forrest. Thanks, Sharon. Appreciate it.
All right, we'll have to touch base again soon and see how everything's unfolding for you guys.